Hello, everybody. Welcome to Boss Blunt's Think Tank. I'm Marcel Kalinovic, the Butcher of Wall Street. Today we're going to be talking about recession, Japanese yields exploding, the mysterious death of 10,000 cattle, Three Arrow Capital and other hedge funds going insolvent, another one bites the dust, crypto meltdown, U.S. stocks being battered on fears of a recession. Even on a green day, whether you believe it or not, S&P and market-wide options in which the bid exceeds the spread, naked shorts on the VIX by the Fed, AMC Gamestop, and a former Citibank vice president and hedge fund manager explains to us in depth what the hell happened in January 2021 that caused AMC and GameStop to go position close only, and the theft and robbery that occurred at that very moment. I'm sure we'll touch on a lot of other subjects as well, so stay tuned. Drop a like if you find information that you've learned, and if you'd like to learn more, please consider subscribing to the Think Tank. Ready, people? Let's fucking go. Good morning, degenerates. How are we today?
Yeah. Living the dream.
Living the motherfucking dream, baby.
Ready to go. Let's get into bubble gum.
Let's get started with BlackRock saying they're not buying this fucking dip. Listen to this, folks. It's about 3 minutes.
Expectations that at least in the first half of next year there could be at the very least a pause from the Federal Reserve as they wake up to the potential recessionary impacts of further tightening and maybe a slowdown in Europe and other parts of the world. What does that mean for portfolios and the way that you are looking at investing? We spoke to Wei Li earlier this week, the esteemed Wei Li of BlackRock. Of course, she said we are hunkering down at this point.
Wei is much more esteemed than I am, so I'll try and build on that. I mean, the main point is that we are not buying this dip. Because it's not a dip. It's actually driven by a shift in the fundamentals of the equity market. We've got a higher rate path. We've got now a rising probability of recession in the US, a very high likelihood of recession in Europe at the same time. And as a result, equities don't look cheap to us. And when you throw in as well that margins, particularly in America, are at an all-time high, real wages have been squeezed. That's the flip side of those high margins. And one of the things that needs to happen in the United States coming out of the pandemic is labor supply needs to recover. And the thing that's going to drive an increase in labor supply is an increase in real wages. So one of the things that's going to help the US to sort out its macro position is actually something that's kind of macro bullish but micro bearish.
So what does that mean? We go to cash?
No, I think there are other opportunities out there. I talked before about the opportunities at the short end of the European and sterling markets. I think also we see opportunities in credit now as well. Credit has repriced. Valuations look more attractive than, say, equities, and the yields have now increased. So this isn't a market where you come out necessarily into cash, but it is a market where we're more cautious. We're looking for signs, particularly from the Federal Reserve, over time, that it is acknowledging the impact it's having on growth. And as I said before, we think the interesting thing is what happens in the first half of next year when the Fed sees what this tightening of financial conditions has done and sees it slowing growth more than it thinks is necessary to actually get inflation back down again.
You came on in April and you called it right on the energy markets. You spoke to Francine, you said, I see further tightness in the energy markets. We are still tight, and the expectations from the from OPEC and the IEA is that will continue. How do you invest around that proposition? Because many people come on and say energy along with healthcare is a place to find some shelter here. Do you want to be positioning around the energy market?
I'd like to note that the Bank of England has just had to deploy backup procedures after a shutdown. Ladies and gentlemen, we're talking financial runs.
markets?
Yeah, I think so. I mean, like I said, back in April, we see persistently tight energy markets and volatile because the underlying structural issue here is the West, particularly Europe, weaning itself very quickly off of Russian energy supply. You talked earlier about the risk now that Russia cuts off gas supply to Europe, which is a very serious economic risk. The ECB talked about it in its most recent projections. That means that we're going to see a scramble for alternative sources of supply in the West. We're seeing the US begin to increase production, but still it's these very high prices that are needed to bring that on. For that reason, energy, commodities, all going to be in short supply and therefore offer investment opportunities.
No kidding.
Yeah, Gordon Ramsay, we know.
Yeah, he does look like Gordon Ramsay. Check out Mohammed Al-Arian saying the Federal Reserve is way too late on policy tightening. And
Has the Fed just committed to driving us
the collateral damage will be significant.
Driving us into a recession?
That is an unfair question because the Fed has no choice but to confront inflation. So in doing so, and because it's late, yes, it has increased the probability of a recession. But the original sin, John, was committed last year. And once you start from such a suboptimal position, you end up in this dilemma, which the Fed has right now, which is going to end up making one of two policy mistakes. Either push the economy into recession with a high likelihood, or alternatively persist with high inflation for too long.
You believe they would take the latter option. Is that still your stance?
I believe they're going to flip-flop. And that's the worst of all three possibilities. That right now they're focused on inflation. As the growth consequences become clear, that they're going to ease their foot off the brakes and then have to slam on the brakes again. And that is my fear, that they will end up flip-flopping, something that we used to witness in the old days with central banks. And I worry that we may see it again. I hope we don't, but I do worry that we may see it again.
Is that weakness clear now, and do you think their dual mandate is in conflict right now already?
So it depends how you define the mandate. If the mandate is strictly defined as employment, no, the labor market is still doing well. If you take it broader and look at growth, indicators are that growth is slowing down. The Atlanta Fed is at 0 for the second quarter. An average of projections see it coming down below 1%. So growth is slowing down, but the good news is that the labor market is still strong.
So, Mohammed, when Chairman Powell says this line from this morning, the Fed is acutely focused on returning inflation to 2%, how much damage do you think he will have to inflict on the economy to achieve that?
Unfortunately, he's going to have to inflict some damage, John. He's late. He's very late. He should have started last year easing his foot off the stimulus accelerator. He didn't. I always go back to the very simple factoid. The week in March that the US printed a 7 handle on CPI, the Fed was still injecting liquidity into this economy. Just think about that, John. So he's very late, and therefore the collateral damage is going to be significant.
Has the Fed just committed to driving us
Hey, boss, you're muted on YouTube and Discord.
Let me see. Nothing over here on the Discord either. I'm going to have to refresh that. Yo, yo. I know you guys can hear me now, right?
There we go.
Luke was back.
How long couldn't you hear me for?
Like 2 minutes.
Okay, great.
Hey,
Thanks
you're
very
back.
much, everybody. Appreciate you. Good looking out. Excellent.
Mortgages are not falling right now, and the news is not talking about it.
The government's way behind the curve. Stable coins are defaulting left and right. The 30-year yield is at highs that have exceeded the 2018 closing high, only to reverse 25 basis points. And then continue trading higher today. 2014. Could be so why they're holding on to that 1,050 mark so hard.
Yeah, I never liked Celsius because of the counterparty risk.
I hear that, dude. Take a look at the market scanners. You guys are going to see it's all OTC pink sheet and meme stocks. Mallinckrodt is up 94,900%. Yep, you heard that, folks. So, they're a publicly limited company that develops, manufactures, markets, and distributes branded and generic specialty pharmaceutical products. They were in Chapter 11 bankruptcy and got shorted into the ground. They were worth 62 cents a share. Today, alone today, they're up 94,900% to $19 a share. Hang on, people are saying I got a bad connection. What the fuck?
They need to refresh.
Possibly.
If you refresh, it will fix it.
I'm showing 3,200 kilobytes a second right now. Pretty strong connection on my end, guys. So yeah, don't scoff at, no, it couldn't possibly make that kind of run, or, that doesn't exceed market cap, blah, blah, blah. These guys were getting shorted into the ground because they had filed for Chapter 11 bankruptcy. Next thing you know, they come out with a stronger balance sheet and more finances. There is 0 shares left to borrow with a 14.5% current fee rate. And it ain't going up because they can't borrow any. But yeah, this was a pink sheet stock. Let's just say, I have a feeling it's not going to be pink sheet anymore, considering the historic volatility is up 1,600% and the stock price at $19 and 95,000% movement in one day. I ain't worried. Revlon also filed for bankruptcy. Traded lower after the company filed for Chapter 11 bankruptcy, but still up 112% today. After trading lower yesterday. Can you say short squeeze? 0 shares left to borrow, 178% current fee rate. They borrowed $375 million in bankruptcy to shore up their supply chain issues. Scholar Rock Holding was up pretty strongly today, from $5 to $8.50.
We need more likes for the algorithm. Please hit the like button so we can help share it.
That's right. Thanks, brother. AMC's hanging out strong at $12.60. Zero shares left to borrow, and the current fee rate has now increased to 16.2%. Atarian is up 10.5. Bed Bath & Beyond up 10.5. Comera Life 28% gains. Heavily shorted stock Clovis Oncology 21% gains. Check this out. U.S. is only days away until an absolute explosion on inflation, according to political strategist Frank Luntz.
Current polling shows 83% of Americans describe the current state of the economy as poor. This comes alongside President Biden's approval numbers continuing to drop, approaching the midterms in November. Joining us now is Frank Luntz, pollster and political analyst. In your long career, Frank, we've seen some, I guess, other periods where inflation finally rears its ugly head, but it's been a long time, but few things really get the juices flowing, like seeing a grocery bill or a gas bill and just going, whoa. I mean, that really is, it affects everyone, and it's visceral, I think. Are you seeing that in Poland?
Yes, we are. And the tragedy is that we've tried to explain this to the Biden administration because they're the ones that need to know. They've refused the presentation. So on your show, I'm going to tell you what I would have told them if they had only listened. We are 13 days away from an absolute explosion on inflation.
Keep in mind, everybody, this was 2 days ago. This was today, June 17th. Saying we're 13 days away from an absolute explosion on inflation. And listen to why. Once you hear this, you're going to realize this guy is making perfect fucking sense.
There are three holidays, there are three moments when Americans take to the roads and when Americans buy more food than at any other time of the year. Christmas, Thanksgiving, and the 4th of July weekend. And everyone's going to be filling up their car 13 days from now, and they can't put $40 or $50 in their tank. They actually have to fill it up, and that's when the explosion hits. They can't just buy 80% of what they want. They have to fill their shopping carts for the barbecues and the cookouts. And 13 days from now, the American people are going to come face to face with these higher prices and face to face with the fact that they can't afford it. You have to go back to 2009, 13 years ago, to find a time when these economic numbers are as bad as they are today. And the difference is that back then it affected roughly 60% of the population. Now, with inflation, no matter who you are, no matter where you live, no matter how much you make, you're impacted by it. And that impact will be felt shortly. And finally, Donald Trump misidentified the stock market as being the aspect of the American economy that people related to when they decided whether things were good or bad. Joe Biden is misidentifying jobs. Right now, you only have a tiny percentage of Americans that feel in any way insecure or unaffected. But inflation touches everyone everywhere, and unless he gets this inflation under control, where people are not exasperated and are not furious and anxious and angry, unless he does something immediately, this is going to affect the midterms. This is already affecting his popularity, and quite frankly, Joe Biden is the most unpopular president at this moment in his term since Jimmy Carter. You'd have to go back to 1978 for the last time a president had ratings this low.
To when you're conducting polls, and I'm sure you're asking not just how is inflation affecting you and how important it is, but you must ask for who do you think caused it, who do you think is responsible? What do you get? The Putin price hike, how many people buy into that? I guess they might say maybe part of it is that, but how many think that that's the main reason that we're in this situation?
And that's the right question to ask for political impact. And a significant percentage, about a third, blame the war in Ukraine for what's happening, although we're not even talking about the shortages. Right now, you can get food, but it's really expensive. With what we know is going to come out of Ukraine in the months to follow, we're not even going to be able to get the food by the time we go into the early fall. And again, I don't think the Biden administration is afraid of the political impact, so they're downplaying the personal impact. And the truth is they should be candid. The other thing that people blame, about 25%, are corporations for taking the opportunity for charging too much. And again, the Biden administration is trying to blame ExxonMobil and companies like that for the reason why gas prices are so high. The key is not who they blame. The fundamental key is who they think is trying to solve it. And this is where the administration comes up short. It was the biggest mistake, and I'm a language person, and that word that they used again and again for the first couple months, that this is only transitory, there are millions of people, literally millions, who now know what that word means and now blame the administration for not doing more. So looking backward, they're not necessarily blamed for having ignored it or for having not done enough. But looking forward, they're absolutely held responsible for why this problem is getting worse and worse. And mark my words, 13 days from now is when it's going to hit its peak. Right now, 1/3 of Americans believe inflation is the #1 issue. I believe that's going to climb to 40% in the weeks to follow.
Easy. Easy. Take a quick look at AMC Ortex data. Short interest is up to 22.9% estimated. Return shares 225K. Borrowed 1.2 million today for an increase of 973,000 more shares borrowed than returned. Minimum cost to borrow has jumped to 17.25%. The average has jumped to 19.82. And the max is about steady at 21%. But remember, they did have to return 30 million shares and borrow them back the next day in order to make that cost to borrow reduce on the max cost to borrow for AMC. This was about 4 days ago, if you guys recall. Very bullish signals. AMC's at 1250, Affirm at up 9%, AMC up 6.5%. Bluebird Bio ran hard this morning, still up 19.9%. Clovis 20% gains. OCGN 11.5%. I was happy to make some money off those calls today. Let's see what else we got messing around with. The SPY's up 0.73. TBT, ProShares Ultra Short Lehman Brothers 20-year Treasury. Down 2.5% today. I'm sorry, half a percentage point. My bad. I was looking at Target. Yep, I'm well aware of Revlon, guys. For some reason, it's not on this list, even though I thought I added it yesterday. But up to 120% gains right now. Nothing left to borrow. 178% fee rate. Let's take a look at the options chain and see what it's looking like. $10 calls are going for 35 cents. The last one sold for 5. $7.50 calls are going for 45 cents. Dangerous stock, but interesting moves ahead. Now, you know what? I got to add this. Let's take a look at our market movers. Pink sheet bullshit, Revlon squeezing, OTC, MREO is up 83%. Bunch of OTC crap. Comera Life Science is squeezing at 30% gain so far today. And don't forget, Mallinckrodt PLC, MNKKQ, up 89,900% still today from a high of $19. 89,900% gain in one fucking day. Why do you think we're not leaving, Ken Griffin? AMC and GameStop are going to make that look like nothing when they're over. Coffee House, I'm glad to hear it. NASDAQ 100 up 1.66%. The SPX up 0.6% after the crypto market is now officially under $900 billion market cap today. As of today, cryptocurrency is under $900 billion market cap. And where do you think that money's going, guys? Right here. Prop up markets, maintain margin requirements, and cover short positions that are getting out of control. Credit Suisse cuts price targets for Adobe Inc. by $100. Dow Inc. has been cut from a buy to a neutral by Citigroup. And Adobe Inc. is receiving target price cuts across the board from $100 to $150, from $150 to $50 a share. Amazon.com, Cohen and Company. You know who Cohen and Company is. That scumbag Steve Cohen. Adjust target price from Amazon to $215 from $42.50. Granted, some of that has to do with the stock split. But they're going right now for $106. You know what? We've got this gentleman here. This is a long video by the gentleman by the name of Charles Gradante. He's a former hedge fund manager. Might even be current hedge fund manager still. And he was former vice president of Citibank.
Charles has a storied history on Wall Street going back to Drexel Burnham in the 80s. I'll let him tell you a bit about his history, including some of that with hedge funds like LTCM, and then he can weigh in on what he saw happening the last couple of weeks. Charles?
Well, I think the write-up on my, hello everybody, first of all, but I think the write-up on my background covers Drexel Burnham and long-term capital. I'll weave in long-term capital on some points I'd like to make. This historic event is historic in one dimension, and that is the retail side of the fence played a major role in moving the market. I'd like to talk about three areas: the efficiency of the markets, risk management, and clearing and settlement. All three are involved in the GME debacle. I'm using GME as just a generic term for the whole situation. With respect to efficient markets, they always correct excessive behavior. And I think with the GME situation, we saw that the hedge funds were muscling retail holders of GME and AMC and the other stocks into submission. And they got a little greedy. And this usually precedes a major correction in the situation. And Reddit and Robinhood day traders saw an opportunity for the short squeeze. But let's be clear, the short squeeze was executed by the retail side, but it was created by the institutional side. The hedge funds created their own debacle. And that's a great segue into the concept of risk management. And in my mind, it's the something I learned at Drexel Burnham. It's the most important aspect of money management. Picking stocks is a difficult game, but risk management is the most difficult, the most important. And greed usually trumps risk management. And we're getting back to the concept of how does a hedge fund get into a situation where they have to run to mommy and daddy for $3 billion to bail them out? Long-term capital, same situation. And at the essence of their issues, I mean, they had structural issues in their portfolio. We can talk about the Russian default in 1998, which led to the debacle with long-term capital. We can talk about other things with respect to the hedge funds shorting GME. But the bottom line is greed. They overshorted. They shorted so much of the stock that it didn't take too much of mediocre mathematics to figure out how to conduct a short squeeze. And black swan events usually precede a liquidity crisis, and this whole GME thing is really a liquidity crunch. We can talk about how many shares were so shorted, the entire float, which is evidence of the greed. I would never have a guy trading for me at Drexel Burnham wanting to short 100% of the float.
Hell yeah!
And it's just, I find it just amazing. It's greed, it's avarice, it's hubris, it's all those things. And the GME was essentially a liquidity crunch to get the bottom line at the stock level with shorting the float, at the hedge fund level with being over levered and over devoted into one position, and at the broker dealer level. I mean, Robinhood wasn't prepared for this from a capital point of view. And on all three levels, we had a liquidity crunch, which resulted in the fiasco, and everybody was pointing the fingers at everybody else. And the hedge fund guys were saying, what the hell are retail guys coming up against us for? And the retail guys are saying, what the hell are you guys shorting the stock? It is worth more than $10. And you had, and then you had the broker dealer saying, do I have enough capital? Now, the bottom line of all of this is, and this is not the only solution, but it's one of the solutions, is that if they had same day settlement and clearing, the broker dealer would have known exactly what their risks were, and they wouldn't have had to shut down trading. So I'm sure they shut down trading for many more reasons than that. I don't have the facts. I have opinions, but I do know that if you peel away the facts, you'll find out that trading on a T+2 basis results in a dilemma. I mean, the dilemma is the day traders are generating profits on a real-time basis. They're using those profits, they're plowing them back in, whether they're making them on the derivative side using options or on the cash side using positions and stocks. And they're plowing those profits back into more positions. Meanwhile, those trades have not cleared and settled. The assumption is they will clear and settle, and you have the backing of DTC and the government behind that. But in reality, if somebody on the street is going to default, go under, go into liquidity, all those trades get busted, and you have a domino effect. So it requires every broker dealer to take that settlement risk, and that's what we call it now, settlement risk, to a degree. And they couldn't, take it beyond what they did. Just as a backdrop from a commentary point of view, back in 1987, I was around when the crash happened. And those days it was T+5. So it took 5 days to clear and settle. And we had to shut down Wall Street for, I think, three days in order for the back office to catch up with the trading. So that is an anecdote. So you can imagine when you had T+2, and you had all this wild trading going on, and the hedge funds got into a frenzy too. Insurance companies and other things. No one knew their balance sheet. The hedge fund wasn't sure of his balance sheet. The retail guys weren't sure of their balance sheet. Were they making money or losing money? And what was their margin? How much were they paying for the margin? and the margin last, and would they be allowed to continue buying calls and all that stuff? So clearing and settlement is something that I haven't heard on CNBC. If anybody has heard that discussed, I'd like to hear what they've heard. But that to me is one area that I'd like to contribute that needs some work in the system. They have to get it down to same-day clearing and settlement, and blockchain technology, in my mind, is the only way to go. Of course, it'll take a couple of years to do all this, maybe a decade, but that is the vision that the people running Wall Street should have for the environment we're in. You're going to have real-time trading, you got to have real-time settlements. So with that, I give it back to John.
All right, great. Charles, that's great. You might not hear it on CNBC, but we're hearing it from you, Charles. That's perfect.
You heard that right.
Why don't we bring Lauren?
You're not going to hear this stuff from CNBC. You're not going to hear this stuff from other players. This guy used to be this vice president of Citibank. He's run several hedge funds. This man knows. He's been in the business since the 80s. He was literally working in the business in 1987 during the stock market crash. This man knows more about what happened than the majority of people in the world.
Back in here too, and open this up to a little bit more of a discussion. And one thing I was going to ask is, and maybe hope you can kick this off with them. Do we know? I mean, the people I've spoken to all seem to agree unanimously that faster settlement would work. But I guess as Charles mentioned, there's some structure in place there that can't just be ripped out and replaced instantly. So maybe it's just going to take some time. Hope.
Well, why is it still T+2? I mean, why don't we have it yet?
It's a matter of technology, the process. On trade date, everybody sets up to settle the securities and the money. So let's assume there's two broker dealers involved. Someone at Robinhood is buying GME, and someone at Charles Schwab is selling it. So Robinhood is buying for their client, and they have to have the cash. And Charles Schwab is selling the security for their client, and they have to come up with securities. Now, mind you, the security could have been lent out on a short sale borrow. So if that's the case, and I think there was some of this buy-ins, we call them, where a short seller, and I'm sure it happened in this case, if you're short 100% of the float and people start buying the stock has to come up somewhere for settlements. So the short sellers got bought in other words, they had to give up their securities, and that starts a snowball. But it's T+2 because on day one, everybody sets up. Robinhood has the money to buy the stock, Charles Schwab has the stocks, and then on trade day +1, the money and the shares cross over, and on trade day +2, everybody reconciles their balance sheet. Charles Schwab says, I got the shares, and they wire Robinhood, and they wire Charles Schwab, and Charles Schwab says, I got the money, and everybody is whole. In the middle of that whole process, you have DKs, which stands for don't know. So one side of that trade could say, wait a second, we didn't do that trade, or we didn't do that price, or we didn't do that many shares. The frequency of DKs is a lot lower. I don't know the number, but that is a monkey wrench that can come in and delay the process more. So right now, with all of the, as John put it, the old world processing steps, which have been automated as well as possible in my mind, the next level of automation has got to be a complete wipeout of the old way of doing things.
And you mentioned to us yesterday, it's like doing manual accounting when you have the ability to, order McDonald's within half an hour. So we're living in sort of a world that seems, especially for the Robinhood users of the world, very incongruous to what they expect. How did we get to this point?
Good point. I want to just, the thing is, we didn't have day trading, we always had day trading, but we never had it at the level we have it now. And it always existed at the institutional level. You had day trading at Goldman Sachs and those guys, the investment banks, and you had day trading in the hedge fund world. But the retail world, the amount of day traders was few and far between. So what I'm saying is, those other day traders could have been controlled. They were controlled by the internal risk management system and the regulators. The retail day traders had no oversight.
Hope, it's almost time for us to move on, but Charles, let's just give you a chance to weigh in here. I mean, Charles, you seem like a free markets kind of guy. I mean, presumably you think the market should act according to what the participants want to do. I mean, do you have any thoughts on, people making trades when there's obviously something artificial happening?
Well, I am a free market guy, but I do see the need for, supervision on these things. Well, we were talking a moment ago about floating more stock. I was thinking about GME, and the question comes up, why didn't they float some stock when it was trading at $300 a share? And that's been a question I've seen quite a bit come up these past few days, but probably let Lawrence address the legal side of it, this potential class action lawsuit by issuing stock on GME when it was up at several $100s a share, especially if you feel there's no way to use the money to save the company. So if you float more equity and you take the money in and you use that money to delay your bankruptcy, and you can't use it to grow your business or reshape your business, then you're opened up to lawsuits for, taking advantage of the situation, only to go to zero anyway.
Right. Okay, Hope, why don't you jump back in here? I think we got a couple questions coming in, maybe from Charles and the others.
Yeah, Charles, while we still have you for this portion, and we'll have more time with you, in the second hour. I guess just remind us how we got to this point where these short sellers became so confident in themselves that they were floating, or they were shorting more than the float.
Well, typically a short seller, does the analysis. I'm a firm believer that short sellers know the stock better than guys that own it long. So they do their analysis, and 9 times out of 10, 99 out of 100, they're right. Then they test the water. They short some stock and see what the reaction is, the price volume action. And obviously they hit jello and they just kept shorting more and more. And the retail investors, were dumping the stock out of fear the stock was going down. And they also come out with their research. We know now that several hedge funds publicized their negative research, which was really targeted not at institutional money managers, but at retail investors. Why are you holding the stock?
FUD.
And they list all of the issues with the company. And they just keep shorting. And nobody was backstopping it on the long side, so they kept shorting it, and that's when the greed comes in. Because there is a point where you should stop. From a risk management point of view, you always have to worry about what's the black swan of this short, and the black swan is a short squeeze. The question is then at what size of a short in aggregate of everybody in the street does it open the way for a short squeeze by another hedge fund even? I'm sure there were hedge funds involved on the short squeeze side. And I can't believe they didn't make the calculation properly. It's not a difficult calculation on what it would take to move the short against you. And that's how it evolves. So like I said, it's risk management that gets trumped by greed. They felt they had the retail side against the wall and they pressed it. And then John's point, and here's the free market, when the reverse was put into place and the retail day traders went against the hedge fund managers who were short, they should have let them ride it. And I think they did, because a certain hedge fund had to seek more capital, and they're likely going to dissolve. And so on that way, the retail investors won. But the other point is regulators stepped in because the street was at risk.
Right.
And so I think the system worked. The system worked fine. It can be better with the settlement issue. That's the thing. I get back to the settlement issue.
Well, it sounds like you believe that short sellers do still play a role in this marketplace.
Yeah, that came up in the 29 crash. Short sellers play a role because they help make the market efficient. Now, I'm not, short sellers that speculate because they see a price, like day traders can short stock because the price volume action indicates the stock is going down. They don't do the analysis, and those are the ones that get hurt. But short sellers play a role. They provide liquidity, they provide pricing, and I think they're value added. I think there needs to be some sort of limitation placed on to prevent someone from shorting 120% of the flow.
I want to just go back to that fateful Friday a couple weeks ago when we saw Robinhood shut down trade of a lot of stocks, and all of a sudden you had Charles Schwab, Merrill Lynch, Morgan Stanley. All of them were stopping buy orders in at least this list of a dozen stocks. And so, people were talking amongst themselves, is this fair? Is it the right thing? So NASDAQ was not able to be with us today, but we've got a comment here from Karen Snows, head of U.S. listings and capital services at NASDAQ, who says one of our main responsibilities of the exchange is to ensure the capital markets operate fairly and efficiently for all participants. Right now, we're seeing the ecosystem try to balance democratization of the markets for investor protection. But I'll tell you this, some people I spoke to who didn't want to be on the record told me it was frankly disgusting when you could see hedge funds cover their shorts and retail investors couldn't buy stocks that they liked and wanted to support and own more.
It's fucking disgusting that retail can't buy stocks in speculation that the price will go up, but short hedge funds can buy stock, can short stock and sell naked shorts that they don't own. That's okay, huh?
Charles, what did you feel about that when you saw it happening?
Well, I agree. I think it was unfortunate that
the
institutional players were trying to muscle the retail side by shorting stocks, inviting them to sell into the short, publicizing their research that they were holding onto weak paper, pressing the short continuously, when the retail side, namely Reddit and Robinhood traders, did their own analysis. They realized that they could execute a short squeeze. As I said earlier, the hedge fund side of the fence created their own problem. So I believe the retail should have pressed their bets the same way the short side pressed their bets. The short side pressed their bets to 100+% of the float. Obviously, they were using more synthetic shorts to get a...
Oh, sorry. Did you hear that? He said obviously. Obviously.
Oh, well.
Their research that they were holding onto weak paper to buy the stock and return the borrow. That ends up creating a cog. And
hold on one second.
It remains to be seen how much of a street problem existed in terms of the balance sheet. That would be the only excuse to have stopped the retail side from buying the stock. And the second factor is, I'm sure the short sellers had buy-ins. Here they are short the stock, and the true owner of the stock, say it's some institution, say it's a pension plan, the stock hits $300 a share, and the pension plan says, sell my 40,000 shares at $300. Meanwhile, the hedge fund, I'm not going to name the hedge funds, but they were sitting on the stock. They had borrowed it, shorted it, and now they have to go out and get it. Maybe they didn't have cash. Maybe they had to go back to their broker dealers and say, we've got to borrow money against our other positions with you.
Oops.
To buy the stock and return the borrow. That ends up creating a cog in the street. And so with the, as we said earlier, with the T+2 settlements, it doesn't take much for the street to say, wait, I don't know where the risk is. I don't know who is holding a balance sheet filled with margin risk. We're not even sure these hedge funds can meet their margin call. Their LPs are not going to come up and give them more money. You're not dealing with a Citibank or JP Morgan where the government will bail them out if they get into a margin squeeze. You're dealing with a hedge fund that will say, I'm out of business.
Right.
So, in summary, I agree with the retail side. I think they got hammered a little.
In summary, I agree with the retail side.
little bit too much, but once we get to see the whole picture, there may be a very good reason why it had to happen.
Charles.
He knows the very good reason it had to happen is because all of these companies would have gone bankrupt. Without that, without them desperately grasping to maintain their wealth, there would have been broker-dealers and hedge funds going bankrupt left and right. The difference is the prime brokers and the broker-dealers would have gotten bailed out, and we would have gotten paid. Let's see if it happens this next time around, as markets are melting.
You mean the market cap would not say that? Oh, yeah.
There's a related question here for
Hey,
you.
boss.
Yo.
Do you have that clip with Gordante when he's sitting next to that nervous-looking motherfucker?
Of course I do.
I really love that clip.
I love that one too. That's a good one.
Audience member.
Another area that hasn't been talked about much. The prime brokers should have known the balance sheet, even though hedge funds use multiple prime brokers.
Do you guys remember that the attorney for Bill Huang from Archegos just a few weeks ago told the judge that the banks knew how the game was played?
They should have known the balance sheet.
Yep.
In terms of what their short position was. And the problem with shorts is that as the short goes against you, it becomes a bigger portion of your portfolio. It's a lot better to be long a stock going down than to be short a stock that's going up. So as the short became a bigger percentage of the hedge fund's portfolio, the prime broker had to know it. And I haven't read anything yet, maybe somebody has, where any of the prime brokers for the hedge fund stepped in and stopped them from acting as well. So the main thing is that the whole system came to a screeching halt, and I get back to my T+2. If we have blockchain settlements and we can do it, if we can trade real time,
that's where it's at.
Why can't we settle real time? We can, but that's the ideal world, so that everybody knows where they stand from a balance sheet point of view and a portfolio point of view. When you have T+2, there's too many question marks. Now, that's a good point, Michael, and I think there's a potential.
And the banks know what's happening. The banks know that they're cooking their books.
Oh, fuck, if they know it.
Yep.
Conflict of interest. Because you had somebody who's involved with Citadel was also involved with the hedge fund.
Oops. Ken Griffin.
That was shorting the stock. And one
Gabe
other
Plotkin.
player we need to bring into the picture, who I know made a phone call when they got the wind of this fight between the short sellers and the retail side, and that is the banking system. You know, the prime brokers are funded by the banks, Citibank, JP Morgan, and they make a phone call to Citadel or to other players, and if they didn't give them a comfortable feeling that they understood the risk, then the bank says, well, your credit line is going to be, you got 42 hours, 48 hours to resolve this question because we're pulling the credit line. So you get that kind of, cog in a wheel too. So there are a lot of players, and Michael, that's a good point. The banks behind all of that had a play and should be at the table as to what their role was.
Yes, sir.
Yeah, I think the key phrase here is redistribution of wealth. The left, let's use AOC as just a metaphor for the entire crowd. That side of the fence will start with the following rationale. What percent of the population own stocks directly? What percent own stocks indirectly, but not directly? It's for like a pension plan. And what percent don't own stocks at all? And they will focus on the third party. And I don't know the number, but I imagine it's millions and millions of people that don't have any stock investment, either through a pension plan, obviously no 401k, no IRA. And these are the people that they represent. These are the people that they let across the border. So that'll be the focus. I mean, if I was advising her, I would say, let's get the numbers. And let's then talk about how can we help those people by taxing capital gains more, number one. How about, they're even talking about taxing unrealized capital gains. I don't know how they're going to do that from an accounting point of view, but that's come up. So, I mean, Janet Yellen said she's willing to think about it. So they're going to think about ways of taxing the people in the markets, especially those directly in the markets like us. And that is not good, not so much from a selfish point of view, but from a GDP growth point of view. You want free markets that are regulated so that we have a level playing field, but you want free markets so that capital formation can take place and flow where growth is. And now it happens to be technology, and you want that play to take on. They'll stop that or slow it down tremendously by changing the tax structure. Look what happened to Europe. I mean, Europeans didn't own equities until about 20 years ago. Did not own any equities directly till about 20 years ago. So that's what socialism and that kind of thinking brings.
Now, keep in mind, this man has been the vice president for Citibank. He has worked for many, many hedge funds and other banking institutions. And these assholes over here work for Citadel. This is a corporate government event and panel with Charles Gradante. Some of you may have seen this a few days ago. This is a short clip. It's only about 10 minutes long. But this man explains everything that you need to know if you don't know what the fuck happened with AMC and GameStop and what's continuing to happen at this very moment.
Well, it's not reported.
Now, there's a little bit of echo for the first minute of the video. It goes away after about 60 seconds. Bear with me, please, because it is kind of important.
Properly in the media, that's for sure. The media will let you believe that that we need to regulate meme stocks, we need to regulate retail traders. But in fact, there's another side of the story which points in a different direction. I think we've all been suspicious when we've seen high volume call buying followed by the stock rising within a week or so, maybe days sometimes, could be even a month. But we associate the rise in the stock with the excessive call buying and sort of make the conclusion that it's very suspicious. The excessive call volume leads to the underlying stock increasing. That is true.
Now, he just said that excessive call buying leads to the stock price increasing. So for those people that say buy and hold, that buying call contracts gives liquidity to the market makers, I'm sorry. I don't mean to be rude here, but you don't understand market mechanics. The thing is, most of the time, you're right. They're not hedging for the calls. And then they're creating married puts, divorce puts, lying about their shorts by marking shorts as longs. They are rehypothecating. They are hiding them with ISDA contracts and futures and swaps. That being said, there's many more ways. I could talk about it for another hour. With that being said, call contracts cause gamma when margin calls occur. Because all of a sudden, they have to either go out and buy shares or buy calls to hedge, or marry them with puts to hedge against those call contracts, my friends. Call contracts, without them, you can have a squeeze. But without calls, there won't be a MOAS.
No calls, no gamma.
True in part, but there are other things going on. When one party is long the call, they have an asset. There's a counterparty that is short the call and they have a liability. The market makers typically marry people that are doing covered calls with traders that are going long a call. So yeah.
He's explaining how market makers create married puts to prevent themselves from having to hedge.
One side going long a call, the market maker looks for someone selling a call and marries the two positions and makes a market. If you have high volume call buying, which is not illegal,
that's right,
the market maker takes the position himself. And as I'm reading the media, you never hear much about market makers doing this. I mean, they pointed to Citadel, but they don't really explain what goes on. The excessive call buying forces Citadel or any other market maker to take the other side of the position. So now you have the retail traders in Gamestop long the
Johannes, I already explained 60 seconds ago. This is their feedback, not mine.
call, and you have Citadel or some other market maker short the call. The market maker has an option to do nothing or hedge. Typically, market makers don't like to take overnight positions, and most of these calls were for at least 1 day or more. So they will hedge that position, and the hedge of being short a call is to buy the underlying stock. That is what moves the stock. So in as much as we can marry long call buyers with covered call sellers, nothing happens to the underlying stock other than information flow about the stock causing the stock to go up for fundamental reasons or technical reasons, momentum, moving day average, whatever. But insofar as the volume on the long side exceeds the natural offsetting volume on the short side, the selling side, the market maker steps in, must hedge their position, and that creates the balloon up. Now, I watch CNBC, I watch Bloomberg, I read all this stuff, and has anybody heard that explanation? Great, but I'm very disappointed, and it's not uncommon that even the regulators are just starting to, I think they understand this, I mean the ones in senior positions, but they don't know how to handle it. Now there are other things, and I'll give it back to you but there are other things that need to be discussed in the situation, because the market maker, in an effort to support now the short seller, Melvin Capital, they will typically borrow the stock, as I think everybody here knows that. They borrow the stock, give it to the short seller. They actually sell it. It never goes to the short seller. Everything stays on the books of the market maker. They sell the stock. They put the cash on their books, memo credit to Melvin Capital, and that's collateral against the short. And that's the typical short selling. But that's not what happened with Gamestop. It did in the beginning, but when the shorting got out of hand on the hedge fund side of the fence, the market makers created synthetic shorts. And that's a whole other issue, and we can talk about that. But the synthetic shorting and naked shorting, which is illegal, a market maker can execute naked shorts insofar as they're facilitating a trade. They're not to facilitate someone shorting a position for an extended period of time. So
just look
so
at
the
that
regulators
nervous
are looking
looking
at that
sweaty
now as to
motherfucker.
whether or not there was this naked shorting by the market makers on behalf of the hedge funds in order to facilitate the shorts. And I think they're going to uncover that there were some issues there, which gets me to a final point. I'll give it back to you. The penalty for naked shorting is really not significant enough to stop it. Citadel and Goldman and
hold on.
get fined.
Hold on, what'd you say?
Is really the penalty for naked shorting is really not significant enough to stop it. Citadel and Goldman and all of the players get fined constantly for doing this. As long as it's not intentional, and never is intentional, they get fined. And I think one of the things we need to do is discuss increasing the fines for this lapse of memory and inefficiency in the system to the point where people wake up and pay attention. Right now, the fines are insignificant. So I have more to say on that, but that's just a taste of where I'm going.
Just a taste, bitch.
Well, it's got to be technology. I mean, we were very paper intensive. In my early days, you had trade date plus 5 to settle, and it was paper. And when we had the crash in '87, it took 2 weeks to settle trades that happened on the day, the Friday and the Monday after the crash. So that's the main thing. I think technology is the answer to any question like what's the difference between now and before. But
Right. So everything has it greatly increased in speed.
yeah. But I think getting back to my points and retail now is a big player on the street, and GameStop shows how important it is to address that sector.
Well, Charles, is that because trades are free now? I mean, back in '87, it would have cost $50 to call your broker and trade, right? Is that why? Do you think that's encouraging?
Well, the trading was more expensive. The bid-offer spreads were wider, and most of the velocity trading was done by institutions that had a moral compass. Not that as a matter of fact, I'm in favor of what the Reddit boys did and girls. They were right in what they did, so I'm not knocking them.
And this is coming from a hedge fund manager, so that's.
But an institution would never push the system that far because the regulators would come down on them and saying, in other words, the question you have to ask yourself, well, why didn't a hedge fund do what Keith Gill did and his followers? Because a hedge fund would do that to a certain point and then cut it because the SEC would be in on them.
I see. So when the retail players rallied together, there was no. I guess there wasn't a single target, or is that why why wouldn't they be? Why wouldn't they go after them?
Well, if Goldman Sachs tried to execute a short squeeze, they have executive management that at some point would have said, "We've made enough money, now cut it out," because the SEC will be on our backs, and we don't need those two-bit no good. So that's important. Whereas the retail guys just said, hey, if Plotkin can short, over 100%, or Plotkin and his cohorts could short over 100% of the float, why can't we buy enough calls equal to 100% of the outstanding or the float? So it was an even up playing field, just that the moral compass is different. The hedge funds got a little bit of a more moral compass, not that much more, but a little bit more.
Well, and Charles, I think you told me that it doesn't take a rocket scientist to realize there's a risk of a squeeze when you have over 100% of the float.
I was surprised when they had the congressional hearing that they tried to set the retail side up for a fall. But it's really the hedge fund world. I mean, they
remember, guys, during the congressional hearing when DFV, Deep Fucking Value, aka Keith Gill, was in front of Congress testifying, more people continued to pile into the stock. They tried to set retail up as the bad guy, and all they did was bring more attention to their problem.
Poor risk management. Once you see the exchanges reporting that 100% of the float is being shorted, and there's synthetic shorts to carry it up to 140% or thereabouts. It only takes a 10% move in the stock to start some shorters to think about covering the short. Most hedge fund managers will start covering their losses if they're long and the stock goes down 10%. At 10% is sort of the demarcation. And if they're short and it goes up 10%, they start covering. There's a simple mathematics. If the stock goes from 100 to 90, you only need 10%, 10.5% to get back to break even. So you start cutting your losses at that point. At 20%, you either double down or cut the position out altogether.
Now, Charles, I want to ask you about something I think we've discussed in the past. We're obviously very, very big fans of NASDAQ here, but I was talking to a NYSE market maker, and he said he felt sick to his stomach that day when you could only put in sell orders for that listed stocks. How did that come about?
Well, like I was alluding to before, the market makers were basically selling to Robinhood and the Reddit crowd naked calls, long, and they were short the call because it's double entry accounting. Somebody's long and somebody's short, and the market makers did not hedge in the beginning. But then when they started hedging, because the volume of calls went to the point where it became dangerous, the hedge to a short call is to either buy another call or buy the stock. And it's much easier to go in and buy the stock electronically than to start. So they bought the stock, and in buying the stock, they were moving the price up. And their attitude was, this call buying will stop, so let's buy the stock, hedge our current position, and hope that the buyers of these calls stop. But they didn't. They just kept going and going and going. So the buying of the long stock on the short call became the issue. And so they got to the point where the exchanges and regulators were aware that market makers were becoming illiquid. They had to settle these trades, and they need capital to do that. And they were spending their capital.
As you can see, you were just told exactly what happens. The same thing that we told you guys. Market makers do not cover for this shit. The only times they actually end up doing that is when they have no fucking choice. When Marge calls.
On the short call became the issue. And so they got to the point where the exchanges and regulators were aware that market makers were becoming illiquid. They had to settle these trades, and they need capital to do that. And they were spending their capital, which is on the to cover the short call. And then that's what blew it. And then they had to stop buying the stock. No more buying the stock unless you're Plotkin or hedge funds where you're short,
Right,
and you want to reduce your risk. But no more buying for speculation. You can buy to cover a short.
Oops. Cheers to that, motherfuckers. Smoke them if you got them, drink them if
So
you
I
got
believe
'em.
a market crash and a recession is around the corner, and I think it's going to be worse than what a lot of people think is going to be. And I don't
Sorry
think
about this
90% of
asshole.
America is ready for it.
That guy is obnoxious. My apologies.
Hey, boss.
What's up?
I know you've probably done it before, but could you put that what you just played? Could you put a link to that in Ape chat? Because there's somebody.
It's
who wants
not
to say that to.
reported.
Yeah, why not? I'll drop a link in Ape Chat.
I know you've probably done it before, but
Bunch
that's a
of times.
really good interview.
You
If
mean
somebody
you didn't
watches,
scroll up?
I mean, I can't see how anybody could watch that and not, get it at this point.
You either understand or you don't. And if people have been, trying to look into it and still don't get it, I think that it's just they don't understand market mechanics, and that's okay, but it's just not for them. Equity fund speculators trim S&P 500 CME net short position by 16,000 contracts on the week of June 14th. That's beautiful. Yeah, just drop that down in there.
Thank you, sir.
I guess I dropped it twice, whatever. Somebody clean that up for me. Three Arrows Capital. You guys want to talk insolvent? Three Arrow Capital is insolvent. Let's take a look at Power Bridge real quick. Just want to see what the hell they're doing. PBTS is up 8.9%. And you can see this stock that's $1.22 was trading for 38 cents a few days ago. Pretty impressive movement on it though. No sound. I'm looking at sound okay over here on this end. But switching it up here. Excuse me one second. Let me pull this up for you guys. You can see exactly what we're talking about. Cryptocurrency is about to get in even worse shape. Crypto hedge fund 3 Arrow Capitals considers asset sales and bailout. Hedge fund 3 Arrows Capital hired legal and financial advisors to help work out a solution after suffering heavy market losses. So here's what's going on with them. Basically, 3 Arrows Capital has a giant target painted on their back. 2 different firms have frozen withdrawals. Celsius Network and Babel Finance. And 3 Arrows Capital is not able to meet margin calls. It's so funny. They're so desperate that they actually ignored the margin calls for multiple days. Check this out, guys.
And they have a grand bonds with Tether.
Yes, sir. All 3 firms basically manage people's money. Celsius, Babel, and 3 Arrow. These were some of the hugest companies, and still are. Babel Finance and 3AC, for example, managed $10 billion in assets in March. All right, Celsius, they published a single statement last week saying that they were going to freeze asset withdrawals. They didn't tell investors when or if they will get access to their funds at all. The CEO tweeted that the team is working nonstop and thanked people for their patience and support, without commenting on reports that they've hired restructuring attorneys. Celsius had $12 billion in assets as of last May. But they lost millions due to a mistake that forfeited restitution payments after the Badger DAO hack, and 35,000 ETH last summer were lost when the Ethereum staking service Stakehound apparently misplaced private keys, and its tokens became worthless as a result. It did not inform customers of the loss. CoinDesk, for example, compared the Celsius collapse to that of Lehman Brothers in 2008. Machinsky, the CEO of Celsius, claimed that they had no exposure to the collapse of US Terra. The report points to other data linking it to staked Ether. But we actually know that they kind of lied on that one as well. Another crypto lender, Babel Finance, BABEL, announced its own freeze on withdrawals and redemptions, claiming it's facing unusual liquidity pressures as recently as May 25th. It had closed a round of funding valuing the company at $2 billion. A report collects claims that Babel misused client funds. And finally, crypto hedge fund 3 Arrow Capital confirmed to the Wall Street Journal that it has suffered heavy losses. 3 Arrow Capital invested $200 million in Luna, the failed Luna protocol that went under, the stablecoin, just a few weeks ago. That investment zeroed out after Luna and its stablecoin Terra crashed last month. So 3 Arrow Capital founders are now saying that they're working with legal and financial advisors, and they're going to try to sell off other assets. They literally ghosted everyone regarding margin calls. They didn't call back. All you got was a voicemail, nothing. That forced other companies to sell off assets and sent crypto prices even lower. Let's just take a quick peek and see how Bitcoin's doing while we talk. 3 Arrow Capital closed its positions with the Bitfinex exchange, but FTX, Deribit, and BitMEX liquidated their positions after the firm, 3 Arrow Capital, failed to meet margin calls. Bitcoin's hanging on to 20,507 right now. Ether's hanging on to 1080 right now. .3AC closed its positions, right, with Bitfinex, but there's 3 others that liquidated them already. And now Finblocks, which is another crypto staking company, has also limited withdrawals to $1,500 per month while it has to analyze the damage from 3AC, 3 Arrow Capital. And Finblocks had over $3.5 million invested in 3AC since last December. So this is kind of a demonstration of how a bad loss from, for example, Luna and Terra, a stable coin, can cause a domino effect. It's a 3 Arrow Capital to Celsius, Babel Finance, Bitfinex, FTX, Deribit, BitMEX, Finblocks, Ether, Staked Ether, Bitcoin, etc., etc. You see how the dominoes continue? Luna collapsed a month ago, and the extent of damage that it did to 3AC didn't even become obvious until this week. Given the connections between 3AC, Celsius, Babel, and all of the rest of the players and the rest of the crypto market that we just told you about, you bet your ass that Ethereum and Bitcoin are not due for a significant positive movement for a significantly long time.
Major liquidity crisis.
Major.
I predict Bank of America goes down first.
Let me think. B of A? Highly likely. Let me take a look and see what their derivatives are looking like. Let's find out who's got the most bad bets.
Yeah, for the CC.
So we'll find that out right now with the quickness.
You know it.
All right, here's the most updated one. Fourth quarter trading revenue was down 10.5% for banks, U.S. commercial banks, as of the fourth quarter of 2021, the most recent available quarterly report on bank trading and derivatives activities from the Office of the Comptroller of the Currency of the United States. 4 large banks hold 89.2% of all industry notional derivatives out of 1,306 banks in this industry. Can you say over leveraged to the tits?
Urgency.
Let's just go way on down here. This is to this 49-page document and go straight to the meat and potatoes. I want a fucking Wagyu today, baby.
Come on.
Top 4 banks. Come on, zooming in as much as we can. Well, my friend, I don't know if it'll be Bank of America. They are really badly leveraged on precious metals, but they're holding $2.5 trillion in assets and $18 trillion in derivatives. Whereas Citibank's holding $1.6 trillion in assets and $42 trillion in derivatives. But wait, there's more. Goldman Sachs has $434 billion in total assets, $40 $7,952,062,000,000 in total derivatives. JP Morgan, $3.3 trillion in assets and $49.8 trillion in derivatives. But wait, there's more. Because we've looked at the top 4 commercial banks. Now we've got to look at the top 4 commercial banks' holding companies. Let's do that next. Man, that's a lot of fucking numbers. Holy debt. Now, top 25 holding companies and derivatives. You got Bank of America's got an additional $3.1 trillion in assets and $32.3 trillion more in total derivatives. The majority of this is rehypothecations of the same shitty derivatives, rebundled in new tranches and resold over and over again. Morgan Stanley, $1.1 trillion in assets, $32.7 trillion in derivatives. Goldman Sachs, $1.4 trillion in assets, with an additional $42.4 trillion in derivatives. Citigroup, $2.2 trillion in assets and $43 trillion in derivatives. JP, $3.7 and $49.2 trillion. It looks like Citigroup and Goldman Sachs are in even worse shape than Bank of America. But the COMEX...
Yeah, there you go. Bingo.
Tell our friends here about the COMEX in short. Just give it to them in the short and stupid way.
Yeah, they have a naked short sale on silver. A huge position they took on from JP Morgan.
So JP Morgan's leasing silver on the COMEX to Bank of America, who's in turn naked shorting it, using that as margin to further short and naked short it.
Yeah, the short is really high.
You know what? In fact, they're so high that it's almost imperative that we talk about it right now.
It would make them insolvent if silver went to maybe $50, $70. Bank of America would need a bailout.
You're muted again, boss.
Yeah, we're back. I actually wasn't saying anything for a minute. I don't know if I actually went muted or not, but we're back. Actually can't find it at this moment, but that's not a big deal. I'm not going to dwell on it. I'll just go look it up on my own in a minute and show it to you guys later. So this is the second week of quantitative tightening, and the Fed has increased its balance sheet by $14 billion, including $20 billion worth of residential mortgage-backed securities. So much for tightening, huh? It's pretty incredible when you think about it.
I don't know how to tighten things.
Hang on a second. What's this? What's this? $2:58 p.m. Central. Market's closing soon. Got 1 minute till market close. AMC just went from 12:30 to 12:59.
And Jimmy's up to 135.
135. That's the end of it, though. That's the top of it for now, it looks like. Let's see if they keep going in after hours, but as of right now, AMC's at 12:59, and that's where it's going to stay. That's the bell. Ding, ding. All right, there you go, folks. AMC finished the day at around 12:52. Ladies and gentlemen, today we have had 9 out of the last 11 days since June 3rd, including June 3rd. 9 out of the last 11 days have been all-time highs on the Federal Reserve's overnight bailout RRP program. The offering reward was originally 0.05%. It has now been increased to 1.55%, 155 basis points over the last several months. This happened just yesterday, this increase. Now Americans are paying a higher interest rate to bail out banks every single day. There was today 103 participating counterparties on this overnight bailout. Banks gave $2,229,279 million to the Fed in exchange for digital, not even printed, digital U.S. Treasury notes. The following day it was returned, and the banks got their $2,229,279 million back, along with $34,553,825,000 in 1.55% bailout rewards. Congratulations, Jerome Powell, President Biden, Janet Yellen. You are literally pushing hyperinflation and killing millions and millions of people. And every single day, as you lie to Americans, you continue to tell people that you're going to stop easing and stop bailing out and start tightening. Yet, the award from billions went up at the beginning of this month from 15 billion to 16 billion to 17 billion. And then as of yesterday, that became 33.7 billion. in one night. And today, that was $34,553,825,000 of bailout money given to banks. That, my friends, is financial crime. That is an all-time high. And 9 out of the last 11 since the June 3rd, 2022, Executive Order 13959 as amended and 14032 were implemented against the companies that finance the People's Republic of China and Chinese military industrial complex companies, is another reason that is contributing, another factor that is contributing to the issues we're seeing with stable coins, crypto broker dealers, crypto hedge funds, New York Stock Exchange market makers, short hedge funds, prime brokers, banks, broker dealers, and other over-leveraged, margin-abusing pricks around the world. This is what's going to lead us into further hyperinflation, a stock market, crypto, and real estate collapse of mortgage-backed securities and equities, and certain commodities, meme stocks, and precious metals are going to go to the motherfucking moon. Ladies and gentlemen, I hope you're properly hedged. I wish you all peace and wealth. Today, trillions of dollars worth of options expired out of the money. As it was quadruple witching and one of the largest options expiry to date. Those are market-wide options. And we continue to see banks be bailed out every single day. At any moment, crude oil is going to pull a 2008 and probably go negative. As you saw today, a 12% drop in WTI and crude oil prices. Immediately before 2008 financial collapse, and every collapse before it, crude oil has subsequently lost the vast majority of its value extremely quickly, immediately before the market crash. That being said, good luck to everybody. Have a great weekend. Market is closed on Monday. I'll see you guys.
Yeah.
Go ahead, Cash.
We're in a liquidity crisis now.
We're in a liquidity crisis.
A black swan soon.
Yes, sir. Too many people fail to realize this fact. But on that note, we're going to be so fucking rich. Have a great day, everybody.
Rich.
I'll wait. But before we go, Tether to US dollar has lost even more market cap. Oops. Who would have called it? Who would have thought? Have a great weekend, my friends. I'll
Hey,
see you in the
boss.
think tank. What's up, homie?
Is it Tuesday yet?
Nope. Not yet, my friend. Not yet.
Love it.
Good luck, my friends. I'll see you then. Thank you, everybody in the community. Appreciate all your support. You guys are the best. If you found some value, please drop a like. Consider subscribing. Share it with somebody.
Hit that goddamn like button.
By order of Cash Money Billionaire.
Do it now.
Gonna be so goddamn rich.
I think it's time to blow this thing. Get everybody in the stuff together. Okay, 3, 2, 1, let's go.
Gonna be fucking rich. I want my fucking money. Griffin, I want my fucking money. Yo, motherfucker. so fucking rich. Listen, I want my fucking money.
You're an original,
Hey,
aren't you?
Yellen, cowboy, give me the fucking money. Get the goddamn money printer out.
Great. Bounty letter.
We're so fucking rich. Get the goddamn